Good morning, everyone. Welcome to Phillip Securities Research Monday morning call. Today we have a few stock counter updates and Philip on the ground with AEM Holdings. Apart from that, we also have a macro sector outlook, and under that we have our REITs monthly, technical pulse, and our SG weekly. Just a quick disclaimer. The information provided in this seminar is for educational purposes only, and does not constitute financial advice. So with that, I will pass over my time to Fahmi.
Great. Thank you, Ash. So next slide, please. Okay, all right, thank you. So Salesforce released their fourth quarter 2026 result last week. So the full year revenue met our expectation, while the earnings were slightly ahead of our expectation. Revenue were 100% of our forecast, while the adjusted PATMI were 109% of our forecast. So the slightly higher adjusted PATMI was because the adjusted earnings per share came in at $3.81 ahead of the 3.03 guidance that it gave. So looking at the positive point, the first is we see growth in the cloud services. The group revenue rose about 12% year-over-year. The higher growth was driven by the platform cloud, which includes products like Agentforce 360, Slack, and many more. So which this platform revenue growth were increased by 37% year-over-year to $2.7 billion, which is above the 12% year-over-year growth in the same quarter last year. Sales Cloud and the other cloud services, which is Sales Cloud and Service Cloud growth were flat at 9%, while the Commerce and Analytics Cloud growth weakened at 1% and 3%, respectively. So we don't see the surging in the group revenue growth because even though the platform were growing at 37% year-over-year, was because of the weakened Commerce and Analytics Cloud growth. The other one positive is the agentic AI tailwind. The generative AI and Agentforce annualized recurring revenue, which is the measurement for the Agentforce product that they released about 15 months ago, which is a fast-growing product at the moment, rose about 1.7 times year-over-year to $800 million. But it's still immaterial at 2% of the group revenue last year. So we see acceleration with the growth offerings, which include products like Agentforce and Data 360. These growth offerings increased about 200% year-over-year to $2.9 billion, which is above the 114% growth last quarter. So we see acceleration from there. So strong adoption with over 60% of the booking coming from the existing customer. And then they also released this new metric, the main metric that they use to measure this AI product that they give out. This is called Agentic Work Unit, or AWU for short, which to measure the AI task accomplished, like for example, decision or record updates. So these numbers rose about 57% quarter over quarter, and cumulatively since a few years back, it is 15 months ago, it is now 2.4 billion AWUs usage. The negative point is that the margin fell. The operating margin fell about 1.5 percentage points. It is due to the margin contraction from higher R&D costs and the increase in sales and marketing costs. For the outlook, we expect group revenue to rise about 10% year-over-year in the financial year of 2027, the new year, and continue to be led by the platform cloud growth, where we expect it to be 22%, then again to be offset by the weakness in e-commerce and analytical cloud, where we expect about 4% growth and 7% growth, respectively, year-over-year. So this recently disclosed cumulative 2.4 billion AWU and 19 trillion token. From our point of view, we think it's demonstrate that the enterprises are the actual adoption beyond just using AI usage, which is slightly different than just using AI usage. To this AW is, from what they say, is measuring the actual work that the enterprise is creating value instead of just using AI usage for just things that it's not creating value. So we think the opportunity for them is upselling to customers with a higher AWU per token, means that they are focusing on higher value customers while at the same time low cost because they are paying less token cost to the AI models providers if they focus on a more value customer. And at the same time, with that, in the next few with that, we think margins can also be expanded as the token cost, if it is declining and AI models become more competitive in the future. And then we maintain a buy combination with a TP of $253, which is from previously $382. We estimate that financial year 2027 estimate revenue to about 1%, while the adjusted PAMI to rise by 10% year over year. We raised our WACC to 9.9%, and we cut our terminal growth to 5.5% from previously 6% due to the competition from what we think AI models providers like OpenAI and Anthropic, which many of these enterprises could just bypass Salesforce product and which eventually reduce the premium SKU adoption on the Salesforce. But then again, we think Salesforce is still less affected by the AI disruption because they release out 3 AI monetization levels that is mentioned. That we think that even with the AI disruption, they could still produce value for Salesforce. First product is called Premium AI SKU. We think this is going to, where the product is AI embedded product and unlimited agentic access on large installed set base that they already have for the already customers that they already have. So this consumption dimension is already nearly triple quarter of a quarter as customer upgraded. And then there's also seat expansion possibility as more of these customers upgrade their seats because now they want to use agentic AI features from this product. And lastly, the lowest monetization level is the consumption credit for customers that use its agentic product on case basis instead of just using it as a subscription. So with this monetization level, we think Salesforce can benefit from the AI, agentic AI theme market. So maybe less affected than the other companies that couldn't show clear monetization level as Salesforce did. So we still maintain a buy call Salesforce at $250. All right. So that's all from me. I will pass over to the next presenter. Thank you.
Thanks, Fahmi. I'll be presenting on Nvidia's results. Yeah, next slide, please. Yeah, so Nvidia's revenue, fourth quarter revenue is within our expectations. PATMI beat our expectations, mainly because of the sustained margins despite the memory prices surging. Yeah, so that's our second pointer under positives. Even though memory prices have surged 42% year on year, their fourth quarter gross profit and net margin, gross margins and net margins expanded about 200 basis points. Yeah, and this is because Nvidia has bundled their products together into a system level kind of system level rack. So for their GB200 and the GB300, they use their NVLink72 technology to connect their CPUs as well as the Blackwell GPUs together. So when they bundle these products, they can pass on these memory prices down to their customers. Yeah, and that's why they are able to maintain these gross margins. And for their networking revenue, it also surged 2.6 times year on year. This is the highest increase since first quarter 2025 of their FY results, which is first quarter of 2024. Yeah, and this is because as the Grace Blackwell systems ramp up, more of these networking are also included within the system racks itself. Yeah, and that's why there's this acceleration in terms of revenue growth. In terms of negative for Nvidia, management guided a slight slowdown in gaming segment because we do think that more of the capacity is being used to prepare for Vera Rubin, which is the next generation GPU ramp in the second half of this year. We don't think that this will have a very material impact on Nvidia's growth because gaming only makes up about 7% of their revenue. In terms of guidance, Nvidia still guides revenue growth acceleration, and they also expect additional revenue on top of the $500 billion guidance previously they provided for Blackwell and Rubin GPU. Yeah, so we are still positive on Nvidia's growth going forward. Our outlook for Nvidia is that we do think that the AI token demand has been accelerating because of the use of reasoning AI models. We estimate that AI tokens has surged by 14 times year on year in 2025 itself. So we do think that hyperscalers will still continue to invest further capex into their AI infrastructure. In terms of their valuations, Nvidia is trading at a forward PE of 24 times. This is a 30% discount to peers average of 28 times, as can be seen in the table at the bottom itself. I think there's a question in the Q&A, why the Nvidia stock price drop after their results? Yeah, I think it's a very good question. Their earnings speed, their guidance is also positive. But I think personally, their stock drop is because, firstly, it's because there's an overall re-rating of AI companies. As you can see in the bottom table itself, now market is only pricing the highest end chip producers at 28 times forward PE. Yeah, so this is a huge drop from the previously it was like about 40 times. That's the first reason. Second reason is because I think market may have some concerns regarding how sustainable the hyperscalers capex will be going forward. Whether hyperscalers will still continue to see return on investments in their capex investments, and also how are they going to fund it. But however, we currently think that the capex cycle is still healthy because hyperscalers operating cash flow is about 550 billion. So this sufficiently covers their capex investments of about 380 billion last year. Yeah, so we do think that currently it is still at healthy levels. We upgraded Nvidia to buy, and we increased our TP to $220 as we roll forward our model. Yeah, so that's for Nvidia. Next slide, please. Yeah, I'll be presenting on Pan United second half results. Their second half results is being driven by project offtake. So as you can see, revenue, which is the top line itself, is within our expectations. It increased 16% year on year, driven by about 12% year on year higher volumes. Second half, their PATMI beat our expectations. It surged by 35% year on year, and this is the highest increase since second half of 2023 itself. And this is because of firstly the higher volumes. Second is also because they utilize their technology investments to gain quite a lot of operating leverage. So an example is the use of their Air Digital platform to efficiently allocate their trucks to cement sites. So this can reduce their truck queuing times and save and lower their costs effectively. Yeah, so second positive for Pan United is that their dividend payout ratio increased by 11 percentage points year on year to 62%. So this 62% is the highest dividend payout ratio since 2020. So if you translate it to dividend yield, it's about 4.2%. In terms of the negative for Pan United, their second half depreciation expense surged by 54% year on year to $17.5 million. This is because Pan United invested heavily in capex to consolidate their patching plants into Jurong Port itself. So we don't think that this is a very negative point for Pan United because firstly, by pumping in more capex, they are increasing their barriers to entry against competitors. Now competitors have to fork out more in order to enter this ready-mix concrete space. Secondly, we do think that because of their margin expansion, they are able to offset this depreciation expense going forward. So our outlook for Pan United is still positive. As you can see at the chart at the bottom left-hand corner, BCA forecasted 2026 ready-mix concrete demand to be about 15.5 million midpoint, 15.5 million cubic meters. So this is about 30% higher than the 20-year average. And this demand is being driven by the major construction projects. For example, Terminal 5, MPS, IR expansion, and so on. Yeah, so we maintain buy for Pan United. We increase our target price to 1.73. We roll forward our model and thus increase our FY26 PATMI forecast by 22%. Yeah, so that's for Pan United. Next slide, please. Yeah, I'll be presenting Phillip on the ground for AEM Holdings. They recently released their their results. Yeah, next slide, please. Yeah, so for AEM Holdings, for those who are unsure, they are a test cell solutions and equipment supplier for a semiconductor company. So for example, for one of their major customers is Intel. So they will do system level testing for Intel, which means that for the chips that Intel produces, for example, for your phones or your PCs, AEM will simulate the kind of environment when these chips are inside the actual phones and PCs itself, and try to find out if there's any bugs or defects. Yeah, so this is the kind of value that AEM provides for their customers. In terms of their FY25 revenue, there's a turnaround. It increased by 5% year on year, and this is compared to the previous year of negative 21%. In terms of their PATMI, it increased by 32% year on year, and this is being driven by the ramp in their HPC customer. There's some speculations that their new customer may be AMD. Yeah, and for their guidance, they have also provided very positive guidance for this year itself, at plus 21% year on year midpoint, because they see increased orders from their existing customer Intel, and they also see order ramp from their new HPC customer. And during the earnings call itself, AEM actually mentioned that there may be a potential contract win from a new customer, which is a hyperscaler. Previously, they have not mentioned this before. So we do think that this is quite they mentioned, yeah, sorry for the dog barking. Yeah. They mentioned that they may announce this contract win this year itself. So that may have fueled the optimism on the ground for their stock price. In terms of our outlook for AEM itself, because of the capex acceleration from hyperscalers, we do think that it is very positive for AEM. And the capex acceleration guidance from hyperscalers are also justified because we estimate that the AI token generation has been accelerating very strongly, up 14 times year on year in 2025. Yeah, so that's overall for AEM. That's all from my end. I'll hand over the time to my other colleagues. Thanks.
Thanks, Iqbal. Yeah, so I'll be covering the two remaining banks that just released their results last week. Yeah, so we'll be starting first with UOB because they were the first to release their results. Yeah, so their 4Q earnings, came in slightly below our estimates, mainly from the lower than expected net interest income and also other non-interest income. It was at 98% of our FY25 forecast. In terms of their dividends, it declined by 23% for their final dividend to 71 cents. So it's sort of expected, because even though they added back their 615 preemptive allowances, you look at the overall net income, and their earnings, they actually did decline. So the full year 25 dividends were at $1.81. This is including that 25 cents capital return dividend. So compared to FY24, it was $2.05, which also included that 25 cents capital return dividend. Yeah, the dividend payout ratio was still kept stable at 50%. Some key highlights and positives and negatives. The net interest income has fallen by 4% year on year, mainly from the NIM compression of 16 basis points, even though this was partially offset by loans growth. Fee income was the real highlight, it has recovered. So if you look at the previous quarter, it actually dipped slightly, but in this quarter, we saw a good recovery by 10% year on year. Allowances has also halved, right? It fell by, I think, more than 50%, mainly from lower SPs, and also we saw credit costs normalizing to 19 basis points. So this is some positive news, and it's sort of expected because in the previous quarter, we saw a huge spike because they were putting on preemptive allowances. So now they did guide that this will be normalized. And I think we will, looking forward in next, for the following few quarters, at least for this year, we will probably see it coming around this 20 basis points mark. So in terms of their guidance, they have guided for FY26. They maintain their FY26 guidance, more or less, right? Their NIM is around 1.75 to 1.8. It was 1.84 in the fourth quarter, and also low single digit loans growth, and credit cost is around 25 to 30. But we believe that there is some opportunity for this credit cost to come lower. But they did lower their fee income growth guidance. It was previously high single to double digit, and now it's only coming in at high single digit. Overall, what does this mean for UOB? We do expect that earnings will increase by 18% year on year for FY26, mainly from the recovery in fee income and some continued growth into the ASEAN sector because of their city acquisitions, and now they're all up and running fully. And also mainly from the decline in allowances. And hopefully we could see some GP write-backs, if their NPAs and NPLs are quite stable. So talking about their allowances, right? We do see that they said that they have seen some hotspots, in Greater China and the US. But if you look at their allowance coverage, they've actually bumped it up quite a bit. And also overall, the hotspots were the CRE. It only makes up 1% of the loan book in each country. So Greater China is only 450 million, and US is only 170 million. And like I said, they have increased their general allowance coverage. It's now 2.1% for China and 4.7% for US. So previously, last year in fourth quarter 2024, it was 1% and 0.8% respectively. So they have bumped it up quite a bit and also increased their NPA coverage. So it's at 60 and 106% compared to 48 and 81%. So they believe that, and also we feel that they have set aside quite a bit of buffers, right? In terms of that last quarter, they did a 615 million preemptive allowance, and we believe that this will be more than sufficient for this year, and also for all the CRE NPAs that we will see in Greater China and US, and also improvements will come in for this year. We have a neutral with a higher target price of $37 for UOB. Now moving on to the next one, we'll be looking at OCBC. So OCBC, their earnings were at 1.75 billion for the fourth quarter. It came in slightly below our estimates at 98%. In terms of their dividend, it was up. It inched up basically 2% year on year to 42 cents, and their total dividends were at 99 cents. So this compared to $1.01 the previous year. So this is inclusive for both years, the 16-cent special dividend. I'll go into more detail in terms of their capital returns, and dividends. So some key highlights: their net interest income fell by 6% from the NIM contracting by 29 basis points year on year to 1.86%, partially offset by loans growth of 7%. In terms of their non-interest income, this was the main positive and also the thing that actually drove earnings. So it surged by 37%, led by the fee income growth of 16%, which mainly came from wealth management. So fee income still makes up a majority of total non-interest income. We also saw a recovery in trading and insurance income. Another positive is also that allowances has dipped, basically from higher GP write-back, and also expenses were very stable. In terms of their guidance, they have provided some guidance. So they did say that net interest income will be slight to moderate decline, which is to be expected from the continued NIM compression, and also mid-single digit loans growth. And the cost to income ratio will be quite stable at low to mid 40%, sorry. And credit costs will also be pretty stable at 20 to 25 basis points. So in terms of their capital returns, I said I'll get back to this here. It's been quite a shift in terms of what they're guiding, because of the new CEO. So they haven't announced any new capital return plan, even though they have one of the highest excess ratios, excess CET1s compared to the other two banks. Right? They haven't announced anything new, but they did say that they will commit to completing the 2.5 billion capital return plan that they by this year, so by 2026. They have already finished their 1.5 billion in terms of special dividends, right? They did it for 2024 and 2025, that's 16 cents. And then they have 1 billion in terms of share buyback. They have completed 220 million of that share buyback, but they're left with 780 million. So what's new and I guess a positive is that the CEO did say they actually much prefer to give special dividends as compared to share buyback, because that's what their shareholders appreciate more. So, they have 780 million left. Just to be on the safe side, we take 500 million remaining, then, we are looking at around 11 cents of a special dividend per share. So that's what we are hoping for. So we believe that they could give that 500 million on a average case basis. On a best case basis, we could see the full 780 million being given back as special dividend. So that will be about just below about 15 cents per share. We do maintain and accumulate with a higher target price of $21.50. So overall, based on what they are guiding and what we are assuming, in terms of their earnings, we expect it to increase by 4% year on year for 2026, mainly supported by loans growth as well as the fee income. We also believe that they can actually continue to exceed that 50% dividend payout that they have been giving because of their excess capitals. They are currently at 15.1% CET1 ratio, and they want to bring it down to 14%, right? So they have the extra 1.1%. We believe that this can be given back in terms of either increasing the dividend payout ratio or even more special dividends. Yeah, so we do like OCBC for their robust wealth management execution as well as the healthy asset quality, which will help to mitigate some of the margin pressures that they are facing, and also to provide that boost to earnings and also give quite visible capital returns. So that's all I have for OCBC. I'll now hand it over to Hashim. Thanks. Also, sorry to that. Yeah, Hashim. Thanks.
Thanks, Glenn. I'll go through Singapore REITs monthly on behalf of Darren as he's away. So overall, this is the share price performance, and we can see that the standouts are overseas commercial, which increased 4.6%. Hospitality also did very well, and retail was down, probably because of the outflow of people during the holiday season. So this shows the 10-year dividend yield spread. We can see that it has been on an increasing trend, and now it's currently about one standard deviation below the mean, and we think this is largely because of declining interest rates, and this has led to the yield decreasing over 3.4% year on year in January. So this shows the forward dividend yield. So forward dividend yield is your future dividend divided by your current share price. We can see that dividend yield has went down most recently, down one standard deviation to 5.5%, and we think this is largely due to the strong share price performance, and given the declining interest rates, we think there is a room for DPU to increase, which can allow for the dividend yield to increase in the long run. So the price to NAV, it has been increasing. So price to NAV is your market price per share versus your net asset value of the share. It's around 1x. What we're observing is that portfolio valuations are increasing, and this increases the base of your net asset value, which means that in the future your price to NAV might go down and can be an entry point for investors who are interested in S-REITs. So next, I'll touch a bit about the general FY25 results and our outlook for each of the subsector. So FY25 results overall, it's broadly within our expectations. On average, there has been a DPU growth of about 2%. REITs that focus on commercial assets, such as OU REIT and Suntec REIT, both of them outperform, and this is largely because their finance costs decreased on average about 15% in the past year. So there has been stable operations for both of these REITs, and in FY26 we are expecting a DPU growth of about 4% going forward. So for the retail subsector in specific, what we've observed is that there has been close to full occupancy, healthy occupancy costs, and there has been limited supply. In 2025, we observe a high single-digit rental reversion. And going forward, we think that the JB RTS link impact will be limited, mainly because we think although there might be some effect on the west part of Singapore, overall for REITs or retail REITs, it's not going to have a significant impact at scale for it to affect our retail scene. With recovering visitor arrivals and government support measures, such as the recently received SG60 vouchers, we think retail will continue to be buoyant. So for the office subsector, what we've observed is that there has been a flight to quality. Those office assets that are grade A continue to enjoy high single digit to low teens rental reversion in 2025. Going forward, there is a limited supply. We are only seeing short tower redevelopment of a square feet of 441,000 that will be coming to market in 2026. But apart from that, there is a limited supply, and we are expecting about mid single digit rental reversion. So industrials wise, we are seeing some moderation. Under industrials, logistics perform the strongest. Business parks, those business parks that are with the best amenities and located in central locations tend to do well. Business parks that are located in a suburban part of Singapore tend to not do so well, and there has been an increasing focus on AEI development within these suburban business parks to improve their specs and potentially increase rental reversion. For hospitality, we are observing mid-single digit RevPAR decline, and this is largely because of a strong base year in 2024. And because F1 shifted to 4Q last year, we observed that last quarter, 4Q did better year on year. Going forward, we see that visitor arrivals have not reached 100% yet, and there is still room for that incremental increase in tourist arrivals. And there has been continued events such as SG Air Show and Food and Hospitality Asia that will continue to support the hospitality REIT. So this is just a retail sales index. It's been largely stable. And yeah, the international visitor arrivals in January reduced 11%. This is a snapshot of our REIT ratings, taking into account the latest results. So I'll also go through Stoneweg on behalf of Darren. So what we observe is that the DPU is 3.1% down year on year. And this was largely because of a bond that they issued at a higher interest rate. So this was at all-in interest rate of 3.9% versus a 3.2% interest rate before the issuance of that bond. And this increased their financing cost, which led to their DPU decreasing. Outlook-wise, the REIT is shifting. I mean, positive-wise, sorry, there has been robust leasing activity with a positive rent reversion. So rent reversion was about 9.8% year on year. And their balance sheet is very strong. Net gearing is 38%, but there is no debt maturing until 2030. So there's no refinancing risk. And because the REIT releases portfolio valuation half on half, we observed that their valuation also increased 1%. Negative-wise, their portfolio occupancy dipped 92.6%. It's a marginal decrease. This is because of asset that's likely going to be sold to the owner-occupier. Outlook-wise, what we are observing is that the REIT is deploying capital into accretive acquisitions, and they are cash rich. They have over $111 million in cash and 70 million in a potential pipeline. And because they had invested in the Ionics sponsored data center fund, they saw close to a 40% valuation uplift on their investment in Ionics, and that has been we expect that to be a strong tailwind going forward. So we maintain buy for Stoneweg with a higher TP of $1, €1.89, and the REIT trades at a DPU yield of 8%. I'll also go through Singapore Airlines update. So for Singapore Airlines, taking into account the associate losses as well as the $1 billion divestment gain that Singapore Airlines enjoyed last year after the sale of the Vistara stake, their their revenue and PATMI increased marginally, about single digits. What we liked about their performance this quarter is that their passenger travel performance was really strong. So passengers increased 6.3% year on year for this quarter, and demand was stronger than the capacity that was brought to the market. Capacity increase was 2.8% only, and this led to yields inching up 1.9% to 10.9%. So the strong performance was largely seasonal demand. This is due to the holiday season where there's increased demand for air travel. And we think it's also because of the network effect that SIA might have enjoyed because of the diplomatic tensions between Japan and China. So China reduced over 60% of their airline capacity to Japan, and we think that might have led to some rerouting of traffic through Singapore. Their cargo segment did do well, and this was largely um, well, we think it's largely because of the Typhoon Ragasa. So this was the strongest typhoon we've seen, and it affected cargo hubs across North and East Asia, such as Hong Kong, Shenzhen, and Southern China. And with US import tariffs, it also affected volumes to US, air cargo volumes to US. And as a result, the revenue from air cargo reduced about 5%. So another negative will be their associate losses. So the story we know is that Air India is still not profit generating, but the new development now is that India introduced a new labor law where there is an increase in the amount of provident fund that they have to allocate. So this is like our CPF, and they are now also including the outsource or the contract workers such as the ground handling staff into social security benefit, and all of these increases cost for Air India. So they made a retrospective provision for these costs, which led to their associate losses increasing 163 million. Outlook wise, we observed that their flight schedule is mainly focused on deepening their connectivity in the high growth regional markets, so mainly in Southeast Asia. But they're also taking an effort to capture the high margin premium business, either through the introduction of newer airplanes with a larger business class portions, or yep. So that's mainly what they are trying to do to capture the higher margin business. So for SIA, we maintain a neutral rating with a higher TP of $7, and it's currently trading at a dividend yield of about 5.3%. So with that, I'll pass my time to Zin.
Thanks, Hashim. Morning, everyone. I'll move on to the technicals. Next slide, please. Yep. So first up, looking at the S&P 500, last week was still relatively sideways. It was down 0.4%. So as of Friday, we're still holding the 6,789 level as well as the 100 SMA, which is the purple line you see in the chart. So I think for now, it's still some sideways consolidation going on since start of this year with lower highs since February. So I think the key for this week to see if is to see whether this 6,789 level will continue to hold. If there's a breakdown below that, I think we could see some that will look at more downside ahead. For currently, the resistance at 6,878 to about 6,947. Support at 6,720 to about 6,810 area. Next slide. Next one, we have our ETF money for February. So we think that US Treasury bonds, gold, as well as oil will extend their gains in March. In terms of the performance in February, was quite mixed. The top gainers were the ETFs tracking oil as well as gold, which were up about 8 to 9%. And the top loser was ETF tracking Bitcoin, which tumbled 21%. For the current trends, I think for US Treasury bonds, gold, oil, as well as Singapore equities, they still remain in uptrend. S&P 500 and Hang Seng Index are in the range consolidation while Bitcoin is in downtrend. For outlook for March, we think that the US Treasury bonds, gold, and oil could extend against. S&P 500 and Hang Seng Index are likely to see some weakness, while the ETF tracking Bitcoin and Singapore equities are likely to do a bit of a sideways consolidation. Next slide. So this is just a summary of our technical calls initiated last week. So we had a technical buy call for Toku at 26 cents. Then as of Friday's close, it was flat. Yeah. So that's all from me. I'll have a time to call for Sembcorp's results.
Yeah, thanks, Zane. Okay, sorry. Yeah, hi. Thanks, Zane. Yeah, sorry for that. So Sembcorp released their full year results. If you go back to the earlier slide, please. So anyway, for the results, we think that there's going to be softness in the operating earnings. But the reason why we still have accumulate because we think there's a pending acquisition, the 5 billion Australian acquisition that will be very earnings accretive, and then this will support any operational weakness. So that's the only reason why we still have accumulate on this stock. Thanks. Next slide. So if you look at the results, was generally in line. The PATMI declined 2.5%. It looks very small, but actually it could have been 20% or 10+% if not because they increased their stake in Senoko by 20%. Because of an acquisition in Senoko, that kind of shielded their earnings from dropping even more. The positive is the renewables. If you look at the very bottom last line at your left, it's a bit hidden because of the red box, but the renewable capacity actually grew 19%, largely because of India. So when your renewable capacity, you're meaning wind and solar increase, then once you build this capacity, of course, this will contribute to earnings next year. So that was I guess the only positive we saw. The negative is the weakness in the gas earnings. If you look on the left again, if you look at EBITDA gas, you will notice there's this down of 25%. So this is the clean number excluding Senoko. So this is basically the electricity business in Singapore. So that was down 25%. So the reason why it's down because gas spreads are coming down very sharply. So this is the first time they mentioned gas spreads, which is essentially the margins, electricity margins was down 50% from $70 to $80 to $30-$35. So in terms of our outlook, we lowered our forecast. We lowered it by 14%. But our target price, we nudged it a bit lower because we actually did push up our EV/EBITDA because of the peer valuations are up, like Apple. But what we think is even though there are multiple points of weakness because of the acquisition and also possible listing of their India renewables, that's why we still keep accumulate. The pressure on earnings will persist. It's not for the acquisition. So like we mentioned, number one, electricity spread is down 50. Even the UK business is bad because of the reliance on petrochemical and the weak demand. And they're also looking at the maintenance shutdown. So this will hit them maybe 5 to 10 million. Then the third area of weakness is the China renewables is facing a rising curtailment. So curtailment is basically, let's say the wind or solar produce electricity, but the grid will not accept it. So you're losing money, although you're producing, but no one's buying. So the curtailment rate used to be 7%. 2024 now is about 14% and could rise further. The reason is because in China there's been too many renewable solar and wind being produced. And just to make the thing worse, there's also a removal of the VAT refund. I think that's like a 10-15 million hit to the earnings also. Next slide. So if you look at the outlook, I won't run through everything here, but just for your reference, it's technically I just copy and paste from my report. But basically on the gas part, which is the electricity business, multiple pressure points like we highlighted. You can read it there. Generation, there should be a growth. That's the only area of growth because of the 19% that they increased last year. And this year, 2026, the capacity increase isn't much. It's only 0.8%, which is a 6% increase. And the urban, which is the next part, the last part, the smaller part of the business is the land sales. So this we think should be stable. Yeah. Anyway, next slide. So move on to ST Engineering. So as the title suggests, escalating defense, basically the escalating geopolitical issues will create a huge defense tailwind for them. Next slide. If you look at the results, generally in line or met our expectations. The one that did well wasn't actually defense. Defense still did well. Is if you look on the left, the red box, the EBIT or operating earnings, it was actually the commercial aerospace that saw a 25% jump in the second half earnings. So why it did well is mainly because of the MRO, engine MRO, that means maintenance and airframe MRO, something like what SIA engineering. Because because of the delay in deliveries, so planes are flying longer, so they need more maintenance. The second thing is also engine part production. It's called the nacelle. It's like a casing of the engine, the LEAP engine, mainly for the A320neo. So that is helping them ramp up the production. Yeah. The negative is satellite. So if you recall, the headline earnings was a loss of I think 400 or 500 million, mainly because they made this was a few months ago, which we did a report also. They announced iDirect, the satellite business. They actually announced a 600 million write-off. But excluding that, it's still losing money, but they are actually taking very aggressive cost cutting, and they are looking to sell this division. So in general, we raise our earnings and to get a sense of the growth. They mentioned that as usual, the orders to be delivered will be about, let's say, 12.5%. Then this is better than last year. We raise our target price. We upgrade to buy, neutral to buy. So, because as we know, right, as we see, I mean, defense spending globally is even before the current conflict we see in Iran. There's already globally there's a major structural uplift. I think we all know this. This is in Europe, even in Japan. So globally, everyone is spending more, and of course because of the geopolitics and so forth. So for ST Engineering, why they would benefit on this is because they are actually looking to double their international defense sale. So, no, ST Engineering used to be very reliant on Singapore defense as a customer, but right now they are penetrating the international markets. They're looking to double from 600 million orders last year to 1.2 billion of orders this year or more. And this should also double again in 2027. So they're penetrating new markets because of the track record, and partly because most of us do NS. So I think that's giving them a good track record with the Singapore Armed Forces. Another thing is automation. So they are gaining a lot of customers in their 155 and 40 millimeter be, of because of the automation and the precision of these weapons or ammunition. Localization is another reason why they're getting more international orders. So because a lot of Middle Eastern countries have seen how ST Engineering has grown from a locally groomed defense contractor, so a lot of Middle Eastern countries also want to emulate this. And of course, neutrality. I mean, not to be too explicit about it, I think we know what it means. I mean, Singapore's neutrality. The other area of growth is, of course, the commercial aerospace. So they're increasing capacity in their airframe maintenance double digit and also the engine maintenance by 50%. So all this will create a pathway for growth in 2026. Next slide. So we move on to venture second half results. We think there's a bottom in sight. Next slide. So having kept venture as a neutral for, I don't know, 3 years or 4 years. So the results was generally in line with our expectations. The margins, the one positive is that the margins has been a record high, maybe at the expense of revenue. But anyway, the negative is revenue. So revenue has been falling since 2017. But we actually are upgrading our recommendation to accumulate. We nudge up a little bit of our earnings, and the target price we push it to 1680, mainly because the PE ratios we're using 19 times. So 19 times has been like the 5-year average highs at the higher quartile of the 5-year average. And then we expect earnings to finally rebound in FY26. So why we say so is the major driver. It all depends on this very one important customer, which is essentially Philip Morris IQOS heated cigarette. So there's going to be a new generation of product which we think will launch in second half of 26. And this will be the big volume driver and growth driver for them. And also because of data centers, they are actually benefiting with the global rollout of data centers. So they have networking products, communication, instrumentation. So all these are also being fed into data centers and helping them turn around. The dividend yield is also about 5%. Their payout is actually they are paying out everything, all the profits are paying out, and also they are backed by strong cash flows and almost 1.3 billion balance sheet. So you're getting some yield here, and our bet is that there will be a turnaround coming up this year. Yeah. Next slide. Move on to our weekly. Next slide. Nothing much in Singapore. I guess loans growth is still steady, still holding up because of consumer. The one interesting one is Korean exports are still exceptionally strong, led by semiconductors. So there's a big semiconductor boom underway right now. Exports is up 29%, and this is after a 34% jump in exports for Korea. Next slide. So in terms of tactical views, of course, we all know what's happening right now. We know the risk. I mean, it's nothing new here. The Straits carry not just crude oil, but also fertilizer that goes to China, methanol that's used in petrochemical products, and also LNG and so forth. The at risk is also the facilities in Saudi Arabia, UAE, and so forth. But right now, we've not seen any attack on the Kirk Island. Of course, these things can change. So we have not exactly seen them Iran attacking all these oil facilities. But anyway, in terms of the implication, we view any major sell-off, especially for the semicon stocks that was sold off today, as an opportunity. I think the midterms election in the US will keep the oil prices the focus. So there is a pain point also for the US administration. They cannot have oil prices being too high. And then you have this whole affordability issue coming out again in the November midterms in the US. And even if you do close the Straits of Hormuz, I think it's also going to hurt the Iranian customers, which is China. So there are pain points on both sides. So essentially the bet on buying this sell-off is just betting on the longevity of this. So if this becomes short, then of course the stocks will rebound. So this is the bet that we are making, that this will not be protracted. I mean, we are guessing here because so our guess is maybe 1 or 2 weeks before this thing ends. The one beneficiary structurally will be, like we mentioned, ST Engineering, because the Middle East is a key market and competition is also tightened. So European competitors also tighten. They themselves cannot keep pace with the domestic jump in demand for defense. And also there's this thing called supply chain diversity. Russia is out of the picture. I don't think anyone's buying Russian or Chinese weapons. So competition has kind of abated and giving a sweet spot for Singapore defense contractors. The bottom is just some of the events. The main one will be the US payrolls. And these are some of our webinars. Yeah. Next slide. I won't share much on this. This is just the loans growth and then deposits. Actually, not. Next slide. If I move on to our usual, every month end, beginning of the month, we'll just give some color on some of the Singapore statistics, the market performance. Next slide. So this is, if you look on the left, this is the sector breakdown, our own way of breaking out the sector. The one that performed well was Yangzheng Shipbuilding, up 22%. The sector, and then the other next is of course electronics. So you look on the right hand side will be some of the top gainers and losers, small, mid cap, everything. So the big gainer in February has been all the semicon stocks like AEM, Franken, yeah, and Micromechanics. And of course gold stocks are like CNMC, especially today. Yeah, and the one on the left is just some losers. A lot of the REITs, I guess. And the bottom is all the big index gainers. So the big gainers were Yangzheng, Keppel, Seatrium. Losers was, I think, largely a lot of the REITs continue to suffer losses last month. Next slide. If you look on this table, is just the asset performance by asset class. So gold ETF was up 9%, the big gainer for last month. Singapore actually still outperforming the US. And Asia Pac ex-Japan, I think last year because of Korea, is up about 6%. So this is in US dollar performance 2026 and for February. Next slide. This is just the Asian stock market performance. So Korea was the big gainer. So year to date, this 2026, Korea is up 48%, thanks to semiconductor memory chips. Thailand is surprisingly up too, and then at the bottom is of course Hong Kong, the REITs and so forth. Just for your reference, this local currency. Next slide. This is our model portfolio. What did well for us was Franken up 29% and Keppel. The one that didn't do well for us was DBS, Prime, and also Lihe, and to a small extent also Geo. The one table on the right is just the performance. Again, this is just for reference. Against the STI, 13 versus 7. Yeah. Next slide. Okay, that's it. I think you can take on questions. Yeah. Thank you.
Yeah, thanks, Paul. Let me take on some questions first. Wait, I saw one earlier. Yeah, okay. It's asking, I'm looking for dividends and relatively stable stock price. Which Singapore bank should I opt for? Yeah, it's quite clear. If you're looking for dividends and a relatively stable stock price, I think DBS would be the best pick based on these two requirements. Firstly, the dividends, you can basically forecast the dividends for DBS all the way until the end of 2027. Right, that's what they're guiding for, and so far they have been giving quite well, and they also give it quarterly, as compared to the other two banks which only give half yearly. So you're looking for a more like consistent kind of dividend earnings than DBS. You already know how much you're gonna get. The rest is all floating. So if earnings dips, then you might not get as much dividends, right? But for DBS, they will just give you a fixed DPS. Yeah. And yeah, the stock price is also relatively stable. Yeah, so if you're looking at, I think it's $3.30. We are expecting for DBS right now. So, based on their yeah, so if you're looking at their current share price now, you're looking at about 5.9% kind of dividend yield for FY26. Yeah, based on current share price, 5.9% dividend yield. Okay, yeah, DBS's CT1, I think it's around 14.9% right now. Let me just double check. If I'm not wrong, it's 14.9%. The OCBC is 15.1, and UOB is also around 15%. So it's relatively similar. Just give me a quick second to double check. Yeah, 15%, sorry. So it's at 15%. So all the three banks are quite similar, but for DBS, the main difference is that we know how much they're giving back. Right? They have been the only bank that actually said they will still continue giving capital return in terms of special dividends for the next 2 years. So that will be the main difference for DBS. So we can sort of predict that they are actually utilizing and trying to bring down their CET1 to their optimal level. Whereas the other two, they don't really say anything, right? Like, even with the most recent results, yeah, they actually did not give any updated capital return plan or even increase it, the amount. Yeah, for OCBC, will their stake in GE continue to be a tailwind for their future earnings? Yes. Yeah, I think this also answers to there's one more question about, let me answer this other question first. Is there any thoughts on local banks from the US bombing of Iran, which will be impacted positively, negatively, or muted? Yeah, I think it will be quite muted. There won't be much impact for the Singapore banks, at least. If anything, if rates are kept up higher, right? If the Fed rates yes, rate cuts are lesser than expected, then this will just be a beneficial for the Singapore banks. But I don't think there will be much impact, at least to the Singapore banks. We might see some volatility in terms of their trading, wealth management side, but I think it'll be minimal. Yeah, no new TP. Yeah, it's whatever I said earlier. Yeah, we maintain the TP and target price and also our recommendation. Yeah, so someone asking about the OCBC, GE. Yes, it will be a tailwind, right? They are quite diversified. I think they're the most diversified ones compared to the other two. They do have a full-fledged insurance arm. So I guess, this will be a tailwind for, yeah, you're right. The diversification will be a tailwind. And we have seen it coming through at least for the last 2 quarters, where their investments have been doing quite well. But it's still quite a small amount. If you look in overall terms, their insurance arm only it's less than 8% of their total revenue, total income. Yeah. Looking at their current fourth quarter results. Yeah. So it's still quite small. Yeah, and also maybe I forgot to mention it earlier as well. It was mentioned, during the when management was talking for OCBC that GE they have no plans to try to privatize it again. Yeah, so at least not in the near term. So I think in the next 3 or 5 years, I don't think they will try to do anything. They still have like 92% ownership of GE, so I don't think they will be doing anything to try to privatize that. So that's not where their capital will be going. Basically, that's what they're saying, because they have that excess capital. Yeah, so it will probably be they're looking at potential M&As, if anything comes up, but we are hoping that this will be given back in special dividends. Okay, let me hand it over to the rest of my colleagues. Thanks.
Hi, I can take on some questions. Yeah, so how's Frankel and UMS results looks lackluster compared to AEM? Yeah, I think you're right. Franken and UMS, I think is flat in terms of net profit growth. I think AEM is about 30%. Yeah, so regarding Franken, right now their key customer ASML has been reorganizing their orders. So they are preparing for their ramp for the high-NA EUV machines. I mean, high-NA EUV systems at the second half of this year. So we are likely to see soft results for the first half of this year. I think that's guided previously in my reports as well. Yeah. As for UMS, we don't cover UMS, but based on what based on the earnings call itself, the customer has been starting to take in the inventory from their stockpile, but the rate of taking the inventory is still slow according to management. So they are looking going forward, they are positive, but they mentioned that it is still subject to the customer's rate of absorbing the inventory. Yeah. Can Food Empire continue to do well? I do think so. I think management is quite confident in terms of passing down any fluctuations in terms of coffee prices to their brands. And I think they also have an upcoming Malaysia facility, so that will also add to their supply as well in order to gain market share. Yeah. Yeah. Sorry, keep skipping. Between AEM and UMS, which one has a better forecast and growth? I think based on the most recent earnings call, I do feel that AEM has a better forecast and growth. Firstly, because on the PATMI results alone, AEM has a better growth compared to UMS, as mentioned earlier. And in terms of forecast itself, AEM also mentioned that there may be a potential contract win from a hyperscaler, which they may announce this year. So in terms of forecast, I do think that AEM has a better forecast. For UMS wise, management still seems a bit cautious in terms of how the customer will react to and how fast the customer will actually take in their inventory. So So in terms of the management tone, I think AEM sounds more confident. Yeah. Sorry, the question skipped.
But just to add to what Yuban mentioned, I think UMS also mentioned that their customers are telling them get ready for a big super cycle of orders. So yeah, so for UMS, their new customer is expected to double the revenue in Penang, and also the current one is at least 20% growth. So the whole semiconductor chain is all performing really well. Yeah. Yeah. Sorry to interrupt you, but go.
Oh, yeah. Okay, thanks. Yeah, OKP valuation seems low, results look okay. Do you see upside ahead? Yeah, I don't think so. OKP, they are mainly involved in the road infrastructure works. I do think that entire construction scene is also in the middle of the up cycle. I do still see upside for this counter, even though we don't cover. Yeah. Why is Centurion results down? They have a big chunk of fair value gains recognized in their net profit last year. So if you just look at their purely on their net profit, it may appear to have dropped. But if you strip out the fair value gains and the one-off, the adjusted PATMI is actually flat. It's almost the same year on year in their second half results. In terms of their adjusted PATMI margins, it dropped a bit because of about 60 million costs in the IPO listing fees. Yeah, so I think that's a bit like a one-off as well. Yeah. What to expect from Broadcom results? I think there will be bigger demand for networking because like for example in Nvidia's networking revenue segment, there's more demand in terms of their Ethernet switches as well. Because hyperscalers want to find a way to address to tackle the energy constraints. So hyperscalers are not looking to build bigger data centers, but more like they're trying to find solutions to scale between the smaller hyperscalers so as to address the energy constraints. So I do think that this is a tailwind for Broadcom. I think not sure if they will announce new order wins in terms of new customers for their TPUs itself, because they are currently I think previous quarter they announced that they have a new customer, and they are also designing TPUs for Google. Yeah, so there may be some demand in that space as well. Subject results look good. Is there a bargain now below $1? Currently their PE is still undervalued compared to its peers, and I think overall the private industrial contracts awarded is still increasing year on year. And I think because of Soybuild's nature as being contractor for high spec warehouse, for example, like Soytech's manufacturing facilities and the semiconductor manufacturing facilities, and also Singapore government in the recent budget they mentioned that they want to set up Singapore as like an AI hub. I do think that this will present like a tailwind for Soybuild. Yeah, so I think the concern for Soybuild is how much the order book and revenue will moderate down, because previously they secured the Tuas Port contract, but which is like almost 500 plus 600 million contract. But this is like a one-off. Going forward, there wouldn't be such big value contracts, management guided. Yeah, so that is also something to think about for Soybuild. Yeah, but overall we are still positive. Yeah. Pan United versus BRC Asia, which one is better to buy, or both good to buy? I think they are both in the building material space. For BRC Asia, they have a bigger market share than Pan United. They are 60% in steel rebar. Pan United is 40% in ready-mix concrete. For BRC Asia, I think the dividend yield has been high consistently for many quarters. So it's about 5.5% yield. Pan United is slightly lower, about 4% yield, but still impressive. In terms of profit growth, uh, BRC Asia recently caught up. It's also about 30% year on year. Also similar profit growth profile. So both of these companies are experiencing the upcycle now. So I think this upcycle will peak about next year. Yeah. So both will be a big beneficiary of this construction upcycle. Yeah. Why did Hong Leong Asia sign fall last week? I think uh there may be a slight moderation in terms of the revenue growth. Revenue growth from the China Yuchai segment, because I think previous half, Hong Leong Asia's China Yuchai growth was about 60+%. I think this half it was 30+%. So there's a bit of a moderation, but there is still growth. And I think compared to Pan United, Hong Leong Asia did not perform that well in the building material segment because some of their short-term land leases expired as they are consolidating the sites into Jurong Port itself. So that's why their building material segment revenue is almost flat. Compared to Pan United, it increased about 16%. Yeah, so I think that may be the reason. What is the TP for the next 12 months? Our previous target price was 90 cents. Yeah, so after meeting with management in the later of this week, we will revise our TP again. Yeah, for now it's 90 cents. Insights on WeHer significant drop. So I think 27. Last week there was a bit of a drop. It may be people's expectations in terms of their results, because when I look at their results, it's still quite impressive results. Revenue and profits both grew. I think profits increased by about 27% year on year. So in terms of the significant drop, it may be people's expectations and also taking profit from right before earnings. Going ahead, the tailwind for WeHer will be the construction order book. It increased by 30% very recently. So their current construction order book is 900+ million. Their worker dorm is also, there's I think few thousand beds upcoming. I think 4,000 plus beds upcoming. Yeah, so that one will also add to their worker dorm revenue. And I think a possible tailwind will be the extension of the Tuas dormitory lease. I think there's a high chance that it will be renewed for the November this upcoming year. Yeah, so that may be a tailwind as well, because of the huge construction projects ongoing. We don't think that the Singapore government will just cut off this 12,000 bed dormitory. Yeah. Sorry, 14,000, I think. Yeah. So that's what we are. I think I'll hand over the time to my other colleagues. Yeah. Thanks.
Okay, let me just try to answer some. Then, sorry, some of because there have been a lot of. Let me try to start the video. Okay, but okay. What is likely next development for the war? When is a good time to buy? We think, like we mentioned, any major sell down, we think is an opportunity. But the bet you're making is that this war won't be prolonged. I mean, that's the one bet you're making. But of course, it's a very risky bet because it's unclear how. But this is our bet that we're making. That this conflict that we see now will probably be a 1 to 2 week duration, because there are pain points from both sides. And it's asymmetrical conflict. I mean, there's only one side has the overwhelming. Yeah. There are some questions on Propnex and APAC Realty. Why Propnex and APAC Realty dropped after results? I think it's mainly because of the outlook. I think if you look at the guidance, we haven't come out with a report yet, but you look at the guidance, most Propnex and APAC are forecasting new home sales to dip slightly compared to last year. And so the earnings for 2026 is likely going to be flat. First half will still be strong because you are capturing the strength in fourth quarter sales. The two upcoming, there are two big upcoming projects coming up. I think that should also do well. So it's more they are guiding for softer softer new home sales. So I think that's the one reason. Any color why Yang Zhejiang did so well? Yeah, we'll try and come up with a feel on the ground. Just that we didn't have time to go through the results and the call. I'm not particularly sure. Even when I look at container rates, it's still dropping. I think it's down. I think 10 to 15% in February container rates. Yeah, so I'm not too sure unless you're making a bet that tankers will go up. So not too sure, but let me come back to you with a feel on the ground next Monday. Can you share a view for Geo Resources? Yeah, so we still like the stock. I think the earnings, there's no briefing yet, but the earnings was below our forecast because there was this one-off tax impact, which we are not particularly sure. There might be a change in government policy. So in terms of the share price, of course, we should be all more concerned of. The next 3 months is very critical because the next 3 months is by June they are looking to complete the new highway and port facilities. So it is, I think, almost 80% completed right now. So once that's complete, the one news flow I'm hoping to get is that before the completion, they will actually sell a stake in this. So this will kind of monetize the value of this whole new road, this 170 million road plus jetty that they're building. So any monetization of it will be the thing that will help the stock. Yeah. I mean, before the actual earnings come from higher coal production and also tolling fee from using the road. So the next 2-3 months will be critical for me because then you know the road completed and so forth. Yeah, but we still have a buy on it. I mean, no change in my view. But the tax, I'm still trying to clarify with the company why the tax jumped up so much. Uh, um, okay. Okay. Is it good to sell Sheng Siong after the results? Don't look like it deserves high valuation. Yeah, I think the valuation is hitting historical maybe 30 times. I need to double check on it. Or extremely high 30s. I think the earnings growth you're looking at probably low teens to deserve such a valuation. I think yeah, it's high. I mean, considering the growth that's out there. Yeah, of course, it's a very good company and stock, but I think I do agree. I think the valuations look very steep for me. Yeah, we'll come in with a note. They had a briefing only this morning, but let me come up with a note so I can give more clarity. Will CSE Global still do well going forward? We don't have official coverage, but we think the outlook will still be very strong for them because they are benefiting from the whole major rollout of data centers in the US. Just to repeat again, when you build a data center, there is the power switchboards, something like our household switchboards, right? But of course, theirs is 1-2 container size. So the demand for power will still be extremely strong because of the huge rollout of data centers. So they will still be benefiting on it. Alltech can comment the recent results and target price. Yeah, the results was actually within our expectations, but the headline was worse because of the FX, because of the strong ringgit, but their billing is in US dollar. So the earnings was weaker than expected because they also had some unrealized losses because they hold US dollar, you hold US dollar cash, right? Then you have unrealized. But we are still waiting for the briefing before we come up with the official report. But we are still positive on it. Not because the name has the word oil, but because we think they're going to get a few more big contracts coming up. Nice results for Takraw. What are the catalysts going forward? Okay, Darren is in a Takraw briefing, but we think Takraw is doing well because they got really good consumer franchise. So the one big franchise they have is actually the DJI franchise in India. Not the drones, but the other products. And the other good franchise, surprisingly, is also some of the beauty products that they're getting from China, like L'Oreal, because a lot of competitors are exiting, so they're also benefiting. And the one that is waiting for is the whole Nespresso franchise for the whole of India. That is coming up, but the earnings is probably only next year, not even this year. So that's the catalyst. There are some pockets and here there they might be developing some India projects and some Japanese projects, and so that's why we're still positive on it. Yeah. I think I leave it to the rest. Yeah, for any for other questions.
I think I'll take a few questions. So the first question is comment on the Lend-Lease REIT rights and will you opt in and why? So the Lend-Lease REIT rights is for 196 million. They are issuing it at a discount to current price. I think it's about 55 cents. So whether I would opt in, I think it's dependent on whether you believe in Singapore retail. The purpose of the rights issue is for them to acquire the remaining 30% of PLQ Mall. It's a suburban mall, and from what we've said earlier, we think PLQ Mall is located in a cluster which we think will benefit a lot. It's at the PLQ quarter, which is not only home to residents but also to office buildings, and we think there's a high amount of footfall, and to us the acquisition makes sense. So if you think if you are a strong proponent of Singapore retail and you think um, the Singapore retail has still has room to grow, then you should opt in. And and this is a rights issue, so if you don't opt in, then there will be a dilution. The next question is, how will the war and higher oil price affect China Aviation Oil? So China Aviation Oil, their main business is that they import jet fuel, import jet fuel, but they also make money through trading of jet fuel. So when prices of oil is very volatile, they stand to benefit, and this is one way that they would actually make money. So the volatility is good for them. These guys don't produce oil. They import oil to supply to the Chinese Aviation Authority. With higher oil prices, maybe there could be some increase in cost in procurement. But recently we saw the news of how their parent company has merged into a larger entity, and so they have a strong balance sheet backing. So overall, we are still bullish on China Aviation Oil because the volatility is good news for them. I think another question on SIA Engineering. So their result was so majority of their result, their earnings was carried by their share of associates. Their engine and components contributed about 80% of the 6.6 million increase in PATMI. And we still maintain the same TP of $4.14. We are still bullish on SIA Engineering. We think that SIA Engineering is expanding their operations, and there has been demand for engine MRO, and they are in a good position to capture that demand. So what's the new TP for SIA with the war? So today I just published the SIA report. I think the TP has not changed. It's still $7. The effect of the war, I mean, the most immediate effect will be that fuel prices. We talked about how oil price went up, so potentially fuel prices might go up for SIA. But they do have a hedging policy in place, which means that even if oil prices move, they might not be as affected, and the hedge in place will protect SIA from that. That being said, if the oil prices volatility and the war is ongoing for a long period of time, then that might make them take a hit. And yeah, so we have a TP of $7 with a neutral rating on SIA. So how deep is SET's investment in Middle East? And there's another SET's question on the performance. So SET's, after their acquisition of WFS, they have evolved from Singapore centric to more globalized. But that being said, majority of the revenue still comes from Singapore as well as Americas. EMEA makes up a smaller portion compared to Singapore and Americas, and we think SETs might not be as affected by this disruption. And outlook wise, we are still given their latest results, their cargo segment did very well. It's the best quarter for them in history, and we are bullish on it, and we will be publishing a report on SETs this week. Any gold stock that could gain from a gold price increase? So we cover CNMC. CNMC price increased about 11% after the US-Israel attack on Iran, and we are still bullish on CNMC. CNMC is expanding. So previously they did open pit mining. Now they are moving into underground mining, and underground mining tends to have higher ore grades, which means that for every ton that you mine, you're getting more gold, and this would mean there's going to be increased production of gold going forward. Their second SOCO mining facility will come online in 2026, and that could further increase their gold production. And they're also doing gold exploration at 2 new sites, which could be beneficial for the stock. So CNMC is the stock that could be a stock that can benefit from the geopolitical tension, although there has been a run up of about 11%. I think that's all. I'll pass my time to others.
Yeah, Fahmi. Okay, yeah. Who's next? Uh, yeah, there's a question. Can you share the Salesforce slide? Can someone just put on the Salesforce slide? Can you read through the questions? Yeah. Yeah, there's a question on Salesforce, Fahmi. Yeah. And also Netflix.
Sure. Maybe someone else take other question first. Let me think about this first. Yeah.
I'll take the Netflix question first. Sorry, I won't be owning my video because I have a really bad eye infection. Yeah, so it's on Netflix after they abandoned their acquisition. And will this provide certainty and tailwind to Netflix and share price going forward? To be honest, this is a very strategic acquisition for Netflix. So on their side, this is something they're willing to do that's expanding them to another genre. But looking at the market reaction, that tells you a core message that investors, they really prefer Netflix just walking away because they really fear of the massive balance sheet leverage. And also there's an integration risk because these two are very big companies. And so there are chances that there's going to be a lot of issue when you're trying to integrate them. So, and also that adds on a lot of their debt. So strategically wise, it's never essential to their strategy. Their global scale has already achieved. Their content engine is internally funded. There's no need for legacy media integration. So I guess walking away, it also kind of shows that Netflix is not willing to overpay for their strategic expansion. So I guess yes, in the long run, that will provide more long-term stability. I hope that answers your question. I'll pass it back to Fahmi.
Yeah, let me just answer as a bit for Absolute 10. So I'm trying to turn on my camera. For Absolute 10 US REIT, Prime US REIT has a negative dividend earnings growth. Why does it still have a buy rating? I think the dividends should be positive. Not sure where that number you got. Sorry if I'm wrong, but anyway, because they are raising their dividend payout ratio. Of course, it's one of our higher risk stocks in our model portfolio, because we're making a bet that the US office market is recovering, which we do see signs of it. So that's why we're making that bet. And they are also guiding for higher and higher dividends. And you can get, if our bet is right, you're going to get that pro-cyclical impact, where as the rents go higher, the cash flows get better, then the valuations also go higher, then the dividends are higher. So we're just making this bet, because we do see signs of the US office market improving, at least bottoming out, especially since there's not much supply anymore. And we do see their occupancy starting to rebound after, I don't know, a few years of decline. So that's our bet we're making on for Prime US REIT. Hi Paul, what are your views on retail gold concept stocks like SPL, Lifestyle, Value Mix, Money Mix? Yeah. So for Money Mix, you can ask Glenn, he attended. But for us, we still prefer the miners. I just get yeah, because I mean conceptually you're just digging it from the ground. Okay, but anyway, because we think there's a greater value add that comes out from CNMC, whereas for this gold retail, it's really dependent on their existing holdings that they have. Of course, higher gold price can actually also boost the jewelry sales. But ultimately, you're still depending on the amount of inventory you hold. So you're getting that benefit because you're holding inventory. But the upside we think for CMC is better because they are generating production growth. If there was no production growth for CNMC, then we are a bit more hesitant. And not only do you get that production growth, when the production is up, you also actually their cost of production also actually came down. So that's the reason why we just conceptually, I guess, we prefer that rather because we think the upside is higher. Of course, the more leveraged way to play the upside cycle in this whole goal upswing. Yeah, can someone flash the REIT performance slide? Yeah, for me.
Yeah, you want me to follow up on I'll follow up on the gold question, I think. Sorry, where was it? Yeah, about Money Max anyway. So I attended the results briefing. So I agree with Paul, right? Money Max is very dependent. Like they did mention it multiple times that they're very dependent on the number of stores that they have. And so now the constraint that they are facing from growth, right? It's really the capital side where they need more capital in order to grow. So they need to continue to expand their storefront in order to keep up with the demand. So I think after a while it's sort of capped, the number of customers that they can get if they just maintain their number of stores, the retail stores now. So they have been increasing it, by 5 to 8 stores every year, right? And that's their main business model now, just to keep expanding, either organically. They can do it by themselves, right? Where they need to, rent a space, do up the whole storefront. Or the other option is to do M&A, which they have been doing mainly in Malaysia, where they've bought. I think recently, a few months ago, they just bought over like 5 stores a smaller business, they just acquired them. So that's the way that they're growing right now, is to grow. So it's not as scalable as as what Paul was mentioning about CMC, where it's constrained by how fast they can grow their stores. And as you know, it takes quite a lot of time to grow your store. You need to renovate, you need to make sure that the location is good, do a lot of a lot of research, on the ground kind of assuring that it's okay. Yeah. So now their aim for Moneymax is just to continue growing in Singapore and also moving it to expanding their business in Malaysia. Yeah. Yeah. So that's for the goal one. I'll hand it back to Ami for the Salesforce question.
Thank you for the question. So how does Salesforce Agent Platform position the company in the AI-driven enterprise software market, and what are the risks of competition from the pure play AI companies? So I think that they position themselves well among the AI platform that we have out there. So what they did is that about 15 months ago, they introduced their AI features for their sales product, which is called Agentforce. For every sales cloud product that they have, like marketing analytics, they equip AI features to this product called Agentforce. Like you could summarize things and all that thing that AI could do. So in this current quarter, they released their AI metrics, which is Agentforce usage, AW, and also the token that they use. So from that, we think that it's positive for Salesforce that we see increasing adoption. And they also highlight some clear monetization, because what's matter from the usage is how would they monetize this, right? So we think that with the high adoption and also with the clear monetization that they told us, the three way of how they monetize this high adoption usage in the near future, we think it's positive for Salesforce, and in a way they are less disrupted by this current AI disruption that we have out there. Like, so that they don't have anything, it's just that they are, and that they also showed some result, but it just takes time to scale. Like the monetization that they told us first is that they already have on the current large customer base that they have, they equip with the Agentforce for unlimited agentic access for this, what we call premium SKU. So they made higher income from that. And second, and on cases basis, people could use agentic. And lastly, as well, the other way of how they monetize is that they are expecting higher seat expansion, more coming from people who want to use agentic AI features from their sales platform. And I think with Salesforce, which is one of the largest CRM with a large sales database, they could make use of that, and also it's like additional features from that, because how good AI is based on how big their data that they have for Salesforce. So based on they recently released high adoption of tokens, AW, and also the clear monetization of these features, AI features that they've shown. At least we think that they are less disrupted by the AI disruption, and now it is a matter of how quick they could scale these features that they have. Yep. So I think it is well for Salesforce out there, how they position themselves in the AI-driven market. Yep. That is all for me. I'll pass over to my colleague if there's anything else.
Okay, thanks, Fahmi. I think I will start sharing on the TA. Yeah. Yeah, so first question of Franca. I think overall this uptrend is still, I believe, is still intact. Because today you see that it's open near the 10 SMA level, this red line, which has been a very important dynamic support since middle of January. So I think it's still finding support over there. Short term wise, I think we could see some resistance at the 218 level, which was the high of Friday, or high volume as well. Yeah, so I think probably we might see some short term sideways consolidation, probably about 203 to 218. But I think overall the uptrend is still intact, and still possible to have higher highs towards maybe 226 as the next level for Franken. Next one for For micro mechanics, I think price also rallied quite a bit. I think yes, hit this uptrend channel resistance over here. So around on Friday about 198, that area, I think there could be some resistance over there. And for now, short term wise, price is still finding some support today from the 5 SMA, this blue line, around 187. So still possible maybe see some sideways movement for now, I guess. Maybe between like 190 to about $2 area. Next one for Pen United, I think overall it still looks positive. I think we've seen a new all-time high above 126, and price is also rising on increased volume, holding the 5 SMA level. In terms of some potential targets, if you use the Fibonacci extension levels, I think the next target about 137, there will be 100% extension level. Yeah, then overall, I think still possibly have some upside towards me. 151 is the next 161.8% target level. So I think overall still looks very good in terms of the chart. Okay. Some short-term support probably around 130 to 132 for now for Pen United. Okay, then next one, there's a question on Nvidia and NVDL. So for Nvidia, I think price overall it's been very sideways. But I think potentially it could be like a bit of a head and shoulders. So we have a left shoulder and a head over here and a right shoulder. Price has been moving sideways with a lot of resistance at 193, and the day before the earnings, I think price tried to break above this 193 level, but after that it was subsequently sold down with increased volume as well. So some potentially a bit of a very bull trap over here as well last week. So but still need some further confirmation, I guess. So currently the support is still holding this important line, which is our support line. Friday's close 177. So that's first level of support. There's next level of support that will be quite important, is 171. So I think if it breaks below this, I think probably we could see more downside here for Nvidia in the short term. Yeah, but for now, I think it's still holding this support as of Friday's close. Some resistance for now, I think, will be very strong resistance at 182, 184. So I think still sideways movement, but potential for weakness if it breaks out these supports in the short term. Then for NVDL, which is the 2 times ETF, also you can see it's here shoulders. So if it breaks below 74 over here, I think you could see some downside towards maybe next key levels around 66 and then 60 for NVDL. Okay, the next questions. Key for Comfort Del Group. Yeah, for Comfort, I think generally at range bound. Last week hit about 155. This swing high resistance today opened with a gap down at 148 over here. So I think short term wise, we could see I think some resistance at 150, 151, which is the 20 SMA level and also a horizontal level. And then in terms of the support, I think that will probably hold if it dips towards 145, 146, which is the lower Bollinger Band as well as this horizontal level. So pretty much range bound, I guess, for now, for Comfort Del Group, between like 145 to 151. Next question for SIA. Yeah, for SIA today, I think tested this previous resistance at 665, held as support. So and then in short term wise, probably some resistance. Some resistance probably around I think 690 to $7 probably with a short term resistance, where previously it was trading this 10 SMA level. I think that will become the short term resistance for now. Then support, I think support probably 677 and 665. So I think could be moving in a bit of a range bound for now. And then if 665 doesn't hold, then that could be more downside towards maybe 650. But for now, I think that most probably hold in between 660 to $7. Next one, Yangzijiang Maritime. I think yeah, for now I think it's still quite range bound. Generally between 57 cents to 62.5 cents area. So for now I think the key will be to see whether the lows of today can hold around this 20 SMA level, which is around 58.5 cents. So if price can, let's say, form a base over here, and then subsequently it can break over 62.5 cents, then we could see some upside if it gets out of this range. But for now, I think still a very much a range consolidation. Yeah. On the weekly charts, yeah, I think this is also this 58, 59 cent area is also quite important because it's a 5 and 10 SMA area for the weekly charts. So price is trying to get out of it, but yeah, for now now it's seeing whether it can hold support over here. I guess probably for now still a bit of range consolidation with some potential upside if there's a breakout. Next one for Apple, yeah, some pullback today. Price open below the 10 SMA level, so short-term momentum is a bit down today. So I think in terms of the near-term support, maybe around 12.30, where it's a 20 SMA level, and then this swing low over here as well. Yeah, then some supports also, probably from the weekly as well. We tested the weekly 5 SMA for now. Yeah, then I think resistance for now probably would be around 12.80 to 12.90 if it covers a Friday scan. So I guess probably maybe some sideways movement for now after a strong rally. Yeah. Next one, Capital DC REIT. Yeah, for Capital DC REIT, I think price action wise is still okay. It's still holding this 10 SMA of the daily, and then some resistance above 230 for now, which is around the upper Bollinger Band level over here. So I think for now we might see some sideways movement like 227, 228 as a support. Yeah, and below that 226 also 80 SMA. So I guess quite a bit range bound for now, as it still faces some resistance above 230, which is the previous horizontal level breakdown in November last year. But supports will still hold. Given the recent steady ascent. So probably quite range bound, I guess, for Capital DC, mainly between like 226 to 230 for now. Okay, next one, that TA for WeHer. I think WeHer has hit close to an area of support. So after the sell down, I think price broke down of this range consolidation, 85 cents to 92.5 cents area. Then there was a sell down with increased volume. Then recently price still making a bit of a lower lows. I think it's hit a bit of an area of support where is testing this previous resistance. That's at 78.5 cents. And the next key support I think that will hold is around 75 cents level, which is this horizontal level as well as upward support line. So I think this will probably hold the price. Yeah. Then it's currently at the 100 SMA level on the daily as well. So previously this was a bit of a support back in November last year. So I think for WeHer probably find some support around this area. Let me see what's the next question. Okay, some US questions. Micron, AMD, and Lam Research. Yeah, for Micron, I think for now, price probably will do a bit of a sideways consolidation. In terms of the weekly, price is still maintaining above the 5 SMA weekly. I think probably 10 SMA is catching up now, and that could be the next support. Currently 377 as of last week's close, and price has moved into a bit of a sideways consolidation with some support at 395 around there. Next one is around 366. I think for some of the longer term moving averages, 50 SMA will be good support for now if it tests it. So currently around 362. Previously during some pullbacks, November to December, that acted as a support as well. So I think price will, I guess, probably doing some sideways movement while waiting for some of these moving averages to catch up. And for AMD, I think in terms of the chart, I think it looks a bit weak. So it looks like a bit of a double top over here at 263. And then this is the key neckline support around 190 to $200 this area. So price has tested this area for it. I think after this earnings gap down, price has held the 50 and 100 SMA levels as resistance over here, moving sideways. So I think a bit of weakness for now, and if it breaks below this, I think this 190 level, and then I think we could see some continued weakness towards some lower levels like 182 previously, this level, and then below that is 170, 171, which was this price gap previously in start of October last year. So AMD for now looks a bit weak, but it's consolidating sideways over here for now. Then the weakness is only confirmed if it breaks below this 190 level. And for Lam Research, I think it's quite similar to Micron. So I think for now, most likely it could do a bit of a sideways consolidation, I guess. Price did like a retest of the resistance at 251 recently, and then some pullback. In terms of the weekly chart, also still holding around 5 SMA level. So the 10 SMA level will probably be a support also. Only 220 as of Friday's close. So then also the 50 SMA also similar to Micron earlier. So the 50 SMA is a good support. Previously in November, December, currently it's around 214. So I think if price dip to that level, probably find some support. So I guess price is doing a sideways consolidation most likely for now first. Okay, let me see. The next question is Hua Tiong Global. Yeah, for Hua Tiong Global, I think for now, in terms of the very short-term momentum, is a bit down as price is after this high volume to hit about 93 cents, price has showed some weakness, breaking below the 5 SMA as well as 10 SMA, which it have been trading out since January this year. So I think probably a bit of a short-term pullback for now, maybe to test 82.5 cents probably is a support level. It's a horizontal breakout level as close to a 20 SMA level. Then I think it probably will do some sideways movement for now with some resistance at around 87, 88 cents. Then afterwards it's around 90 cents. So probably my guess is a bit of some pullback and then doing some consolidation afterwards, after a rally. Next question on Capital Invest, Yanlong and City Developments. Yeah, for CLI, I think for now it looks like some probably some short-term weakness. I guess after price kept down after the earnings over here, it tried to pull back up to actually fill this gap around 313, and then there was resistance. Afterwards, we see some weakness down below. Price is trading below the short-term moving averages for now as well, and the weekly also is currently below the 5 and 10 SMEs levels. So for now, I think we might see some perhaps some weakness, maybe to test this level again, close to this window, 290 to 295 area, that will be support. Then I think most likely do be a sideways movement afterwards, with some resistance around above like 305 for Capital Invest. Next one for Yanlong, I think it's looks like it's still kept in a bit of a range bound over here, with some resistance at 76 cents to 78 cents area. Then generally support is coming in close to 69 cents at the low. Yeah, for now, then some support at currently at 72 cents. Yeah, so I think we're still very much range bound for now. Yeah, then some reasons for now currently is around probably 74.5 cents to 75 cents. So I think still quite range bound for yen dollar. Next question on city developments. I think short term wise, we could see some weakness as price is trading below the short term moving averages, and then there was this bearish candle actually break down below some of these moving averages that it was trailing. So previously it was trading along the 10 SMA level, and then there was a breakdown currently. So I would guess some short term pullback or consolidation is likely. Support probably still holding at 930, which is a weekly 10 SMA level. So I guess probably some sideways trading, I guess. 930 to maybe 980. 980 probably is a bit of resistance for now. Okay, I'll take one more TA question, which is oil tech. Yeah, for oil tech, I think in terms of the chart, I think it's looking a bit better. So in terms of the week, if you look at the weekly charts, price previously during the downtrend, it was facing resistance from the 5 and 10 SMA weekly. Then there was a breakout on mid-February afterwards. Currently, I think it's doing a bit of a back test, I guess. So the 70 cents level to 70 cents to 72 cents, this area probably will hold on the weekly chart. On the daily also needs around or needs a retest of this resistance breakout. So previously this 72 to 74 cents area was resistance, and price broke out above. Currently, I think it's doing a bit of retest over here. So I guess will form a bit of a higher low over here. 70 cents to about 74 cents area. Probably will find some support and do a bit of a rebound, I guess. To maybe try to retest this 82 cents swing high again. Yeah, so I think for oil tech, there's probably a good chance of a bullish reversal taking place. Yeah, so I think that's all for me. I'll hand the time back to Paul if any more comments. Thanks.
Yeah, thanks. Thanks, Dean. Yeah, we're trying to answer as many as we can. I think there's we did answer like 70 questions. Is there arbitration risk ahead of Seatrum? Yeah, I need to get back to you on this. Apologies, I didn't really go through the details for Seatrum. We try to provide a lot of affiliate on the ground that's missing, like Wilmar and Seatrum, all that. Just that all these companies release the result at the same time. So like 50, 60 companies release on the same day. So it's hard for us to kind of give you back a feedback. There's a Far East Hospitality Trust. I think Mr. Hashim can answer that. It's all likely to rebound the days ahead. It's sold off from to open today. So again, we just think it's just I think the sell-off in the oil price, I'm not sure where is it now. It's maybe because people just don't think that this will last long. This conflict, especially when Trump said that this is going faster than expected. So this is our view. We think any major sell-off, especially in the semiconductor stocks, that's where the opportunity. Another question is, why is Keppel dropping today? Is it a good time to buy? So for Keppel dropping, I guess it's in line with what's happening in the market. But do know that Keppel indirectly does benefit from higher oil price because they have that 4 billion of rigs on the balance sheet that they're looking to dispose. These are the legacy rigs. I'm not sure what C852. More upside ahead for add value tech with the establishment. Okay, I'm not sure it's because of the national space, but I think if you don't have add value, the last 4-5 years, they have been investing on one specific solution for satellites. So they're actually using not the Starlink, but they're using the Neo and the Geos. The satellites technology to communicate between each other before relaying down to the Earth. Let me try to explain it a bit better the next briefing because I don't have time. But they took that 5-6 years to develop this new solution. That's why they are doing well. But I'm not sure. I'm not so sure how long this can last. I do not know. But the next 1-2 years still looks okay. Just that it's a very neat solution, so I don't have an answer how big this market is. How's Geo's results? So Geo's results was good. Just that there's this one-off peculiar tax. We'll explain later in our briefing. But there was a change in the way they computed tax, and because the Indonesian price that they use was higher than the selling price, so there is an anomaly that has been rectified right now. Yeah. I know it sounds a bit confusing, but any new development on Takraw? Darren's in the Takraw briefing, so I think he'll give you any thoughts on upcoming Bauxite REIT IPO. Good to I don't have the details. Maybe Darren can give, but what we understand is that it's industrial assets and very hard to differentiate the industrial assets. And there's also some Japanese industrial assets that they put in. So I think differentiation for this REIT is going to be a bit of an issue. Okay. Okay. I think I'll leave it at this. It's already 1 o'clock. Anyway, thanks everyone for your time. Sorry we couldn't answer every question. We try our best. I think we answered like 85 questions. So thanks everybody for your time. Hope it was useful, and hope you have a wonderful week ahead. Thank you everyone, and Xin Ning Kuai Le, our last day tomorrow. Bye bye.